Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lucid.
And if you find our talks useful, please consider subscribe, like, and comment underneath. We really appreciate it.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10 Bitcoin with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so picture this for a second. You're looking at a company, right? And the prediction markets, the actual folks placing real money bets on outcomes, they're pricing in a 51% chance that this company files for bankruptcy by 2027.
Wow. Literally a coin flip on survival.
It's essentially a coin flip. But at the exact same moment, you have these massive tech funds and Fortune 500 partners backing up the Brinks truck. I mean, they are pouring billions of dollars into this very same company.
It is honestly the absolute definition of market polarization. You have this dramatic, almost unbelievable contrast happening right now.
Yeah, that's wild.
Because on one side, retail speculators see a sinking ship, but then some of the most sophisticated smart money on the planet sees a generational buying opportunity.
And that tension is exactly why we are unpacking this today on the Deep Dive. Our mission here is to figure out what exactly the smart money sees that the prediction markets are totally missing.
Right. We need to see if this is an actual undeniable washout bottom.
Exactly. We're asking the big question. Is this a falling knife that's just going to keep slicing through your portfolio? Or is it an asymmetric turnaround opportunity secretly backed by a massive $4.7 billion lifeline?
All right, let's move into the wealth building context.
Because if we're trying to figure out how a stock with a 51% bankruptcy probability fits into any kind of long-term strategy, we really have to understand what the company actually does today.
Yeah, the market still seems to think they're just a luxury electric vehicle startup, trying to sell high-end sedans to dentists in California.
Which is such an outdated narrative at this point.
Completely outdated. I mean, if you evaluate them purely on those luxury sedan sales, you are missing the entire structural shift.
Right, because they're actively transitioning away from being just a consumer car brand.
Exactly. They are becoming this foundational, autonomous robotaxi partner. They basically want to be the hardware and powertrain layer for the future of autonomous fleets.
But I do want to push back on that a bit, or at least inject a heavy dose of reality for anyone listening.
Fair enough. Hit me.
As practical investors, we have to understand the vehicle we're driving here. This is not some safe, dividend-yielding utility stock, right?
Definitely not.
The analogy I've been kind of tossing around is this. Investing in this company right now, it isn't like buying a mature apple orchard where you can just, sit back and pick the fruit every season.
Right. You're not getting immediate yield.
Exactly. You are buying a highly speculative plot of raw dirt, and right now you are paying for some incredibly expensive fertilizer.
That is a perfect way to visualize it, honestly. You aren't buying the harvest, you are funding the terraforming.
Yeah, the terraforming.
The wealth building potential here is tied entirely to their 2027 strategic pivot and that commercialization phase. So if you put this in a multi-year growth portfolio, you are doing it because of the structural moat they are building right now.
Specifically, their deep integration with Uber and NVIDIA. So, you really have to be comfortable with volatility. You are going to look at a sea of red on your portfolio tracker for a while, just trusting that the 2027 phase is the actual payoff.
Which is a tough pill to swallow for a lot of people.
It is. Now let's look at the fundamentals.
Yeah.
Because we need to talk about the cost of that fertilizer. Looking at the Q1 2026 earnings, it was painful.
It was a brutal quarter just on the surface.
Yeah, genuinely tough to read. We are talking about a severe revenue miss. They brought in just under $282.5 million against an expectation of over $440 million.
That is definitely not a small rounding error.
No, it's massive.
Yeah.
And the bottom line is even more staggering, honestly. They posted a $1.03 billion net loss for a single quarter.
Just incredible cash burn.
And gross margins sank to negative 110%. And just to make sure we're all on the same page mechanically about what a negative 110% margin actually means, it's like if they sell a car for $80,000,
Right.
it is costing them roughly $168,000 just in parts and factory labor to build the thing.
That is just wild. Every time a car rolls off the line, they're basically lighting money on fire.
Exactly. And that's before you even factor in research, development, or corporate overhead.
Which naturally leads to the free cash flow burn. I mean, if we look back to 2025, they had a $3.8 billion cash burn.
Right. So the immediate logical question any risk-aware investor has to ask is, well, with that kind of burn rate and margins that negative, how are they not completely insolvent?
How are the doors still open, right?
Exactly. How are the lights still on?
So to understand that survival calculus, we really have to look at the mechanics of the Q1 miss, rather than just panicking over the headline numbers.
Okay, break that down for us.
Because it wasn't a demand cliff. A demand cliff is when consumers just, stop wanting the product. Nobody's placing orders at all.
And if that happens to a startup burning cash, it's just game over.
Exactly. But in Q4 of 2025, which was just one quarter prior, they saw 122% year-over-year revenue growth. The demand was actually accelerating.
So what on earth caused the massive revenue crater in Q1 then?
It was a production delivery gap. Basically, they manufactured 5,500 vehicles in Q1, but they only actually delivered 3,093.
Wait, that is over 2,000 cars just sitting on asphalt somewhere. Why couldn't they deliver them?
It came down to a temporary supplier stop sale on their new Gravity SUV.
Oh, interesting.
Yeah, essentially there was this isolated issue with a specific component from a third-party supplier. And because of, regulatory and safety compliance, they legally could not hand the keys over to the customers until that component was verified or replaced.
Wow. So the vehicles are fully built, the customers are literally waiting.
Yep, but accountants cannot recognize the revenue until the delivery is actually complete. So the revenue wasn't destroyed, it is just bottled up in inventory.
Okay, well that makes the revenue miss a lot less terrifying. It's a bottleneck, not a cliff.
Exactly.
But, I mean, that still doesn't answer how they are keeping the lights on with a multi-billion-dollar cash burn.
Right, and this is where we talk about their $4.7 billion in pro forma liquidity.
And just to quickly define that term for everyone, pro forma means they are projecting their available cash based on deals that have been finalized but maybe hadn't fully cleared the bank by the end of the quarter.
Exactly. They are heavily backstopped by the Saudi Public Investment Fund, or PIF, and they just extended their runway with a massive $1.05 billion capital raise.
And who exactly is writing those massive checks?
It included $550 million from a PIF affiliate, and this is crucial, an expanded $500 million investment directly from Uber.
Which brings us to the obvious question, why? Why is Uber handing over $500 million to a company with negative 110% margins?
It's a great question.
What is the technological moat that makes this company so incredibly valuable to a giant like Uber?
It all comes down to technological supremacy, specifically their next-generation electric drive unit, which they call the Atlas.
The Atlas, right?
Yeah, they aren't just taking off-the-shelf batteries and, slapping them into a metal chassis like some other startups. The Atlas unit is a marvel of miniaturization and efficiency.
How small are we talking?
They have integrated the electric motor, the inverter, and the transmission into a single, incredibly compact unit that literally fits in a carry-on suitcase.
Oh, wow. And why does that matter so much for a robotaxi specifically?
Because of efficiency. Clean sheet engineering means their vehicles get more miles per kilowatt hour of energy than virtually any competitor on the market.
So for a normal consumer, that just means less range anxiety.
Exactly. But for a commercial fleet operator like Uber, efficiency is everything. I mean, if your robotaxi can run for 14 hours instead of 10 before needing to be pulled off the road to charge, your utilization rate just skyrockets.
Right, you just make way more money per vehicle.
Yes. And furthermore, a highly efficient motor means you can use a smaller, lighter battery pack to achieve that same exact range.
Which drastically lowers the cost of the vehicle itself.
Precisely. That underlying technology is the reason the Saudi Sovereign Wealth Fund and Uber are willing to just absorb these brutal short-term losses.
Because they aren't investing in a Q1 earnings beat.
No, they are building a bridge to that 2027 vision.
That brings us to the catalyst timeline. Because, the technology is clearly there, the funding is secured, but when does this actually translate into positive momentum for the stock?
Right. What should we be looking out for?
Exactly.
Well, the next 3 months are going to be hypercritical. We have the Q2 2026 earnings call coming up, likely in August. And this isn't going to be your standard boring quarterly update.
Why not?
It's expected to be a massive catalyst because the new CEO, Silvio Napoli, is slated to conclude his comprehensive strategic review.
Ah, gotcha. And whenever you have a new CEO step in, you usually get what's called the kitchen sink quarter.
Exactly, the kitchen sink.
They just throw all the bad news, all the write-downs into their first report to lower the bar as much as possible, so everything after that looks like amazing growth.
And that's very likely what we're seeing the tail end of right now with these brutal numbers. But looking forward, Napoli is expected to reissue the suspended 2026 guidance.
So the market really wants to see if they are still aiming for that 25,000 to 27,000 vehicle production mark.
Yes. And more importantly, he has to outline the actual mathematical roadmap to positive unit economics. Investors desperately need to see the step-by-step plan for climbing out of that negative 110% gross margin hole.
There's also a really fascinating speculative angle here regarding that Gravity SUV stop sale we talked about earlier.
Oh, for sure.
Because if they announce during the Q2 call that the supplier bottleneck is totally resolved, all of those fully built vehicles sitting on lots immediately turn into a massive cash inflow.
Yes, you get a sudden positive revenue surprise that Wall Street analysts simply aren't modeling into their Q2 spreadsheets right now. It basically acts like a coiled spring.
Right.
And if we zoom out to the broader macro view, we have to look at the late 2026 targeted launch of the first Uber-native robotaxis. They're actually planning to deploy these in a major U.S. city.
Yeah, the timing on that couldn't be better, considering the current market obsession with artificial intelligence and autonomous platforms.
It acts as a massive tailwind. You see NVIDIA hitting record valuations. You see Uber committing $10 billion to their autonomous push.
Yeah, that entire sector momentum creates this massive upward force for any company credibly positioned as the hardware layer for AI driving.
Exactly. It's a rising tide that lifts the boats that actually have the proprietary technology to float.
Now let's pivot to the chart, because the fundamental narrative is definitely starting to make sense. But if we look at the chart, man, it requires a strong stomach.
It really does.
We are looking at a very steep, punishing, longer-term downtrend. From a purely structural perspective, the stock is trading heavily below its major moving averages.
Very heavily.
It is stuck under the 50-day moving average, which is sitting around $8.47, and it is miles below the 200-day moving average of $14.30.
And for those who might not chart daily, being under the 200-day moving average means the institutional market basically considers the stock guilty until proven innocent.
Right, those averages act as heavy ceilings. It's just overhead resistance where trapped buyers try to sell and just break even.
Exactly.
So the stock really needs to clear the $7 psychological resistance barrier to confirm any kind of real structural trend reversal. Until it pushes above $7, any upward movement is technically just a relief bounce in an ongoing bear market.
That's true. But while the overhead supply is definitely heavy, we can't ignore the momentum shift happening right at the floor.
What are we seeing there?
We are seeing a classic basing and accumulation phase. The stock recently surged 9.65% in a single session, and it didn't just happen randomly.
Wow.
It bounced decisively off the $5.50 support zone. That level is acting like reinforced concrete right now, sitting just above the 52-week low of $5.62.
And the underlying momentum indicators actually validate that bounce, which is great. Even with the ugly longer-term moving averages, if you look at the MCD, the moving average convergence, we just got a bullish crossover.
Could you maybe break down how that crossover works for someone newer to technical?
Sure, yeah. Think of the MCD kind of like comparing a runner's time on their most recent lap to their average time over the whole race.
Okay, I like that.
So if their recent lap is suddenly much faster than their average, momentum is shifting in their favor, even if they are, still at the back of the pack overall.
Right.
Mechanically, the short-term moving average crossed above the longer-term moving average. Furthermore, the histogram, which is basically a visual bar chart showing the distance between those two moving averages, it is flipped from negative to positive.
That visually confirms that the downside selling pressure is exhausting and buyers are taking control of the short-term trend.
Exactly.
And crucially, there's plenty of room for it to run before it gets exhausted.
Yes, the relative strength index, or RSI, is sitting at a very neutral 54.75.
Right in the middle.
Yep. The RSI measures how overbought or oversold the stock is on a scale of 0 to 100. So at 54, it is right in the middle. It isn't overextended at all.
So if a catalyst hits, like that stop sale resolving, there is plenty of technical runway for speculative capital to rush in and push the price significantly higher before algorithms trigger any kind of overbought sell signals.
So what does market sentiment look like? Because this is perhaps the most fascinating part of the whole story.
It really is. We are seeing a massive institutional rotation happening.
You're talking about Coatue management, right?
Yes. Coatue is a major, highly respected, tech-focused hedge fund. They essentially cut their massive Tesla position by 96%. I mean, they practically liquidated it.
Wow.
And they took that capital and initiated a brand new position in this company instead.
That is a staggering vote of confidence.
Oh.
I mean, when smart money rotates out of the undisputed established market leader and funnels that cash into a battered, cash-burning competitor, you have to pay attention.
You really do. They are betting heavily on the technology gap closing. And it isn't just hedge funds making these bets either.
Right.
We mentioned Uber's cash injection earlier, but they actually increased their passive equity stake in the company to 11.5%.
That's huge.
When a Fortune 500 company that you are partnered with buys up over 10% of your total stock, that is a strategic lock-in. They are broadcasting to the entire market that they rely on this specific hardware for their future operations.
But I do have to provide a reality check here because Wall Street consensus is violently polarized. This is a true battleground stock.
Oh, absolutely right.
On one side of the aisle, you have Citigroup maintaining a buy rating. Now, they did lower their price target down to $14, but maintaining a buy through that catastrophic Q1 earnings report shows immense conviction in the 2027 robotaxi thesis.
But not everyone agrees.
Not at all. On the other side, you have Morgan Stanley downgrading the stock to underweight with a $5 target.
Ouch.
Yeah, they are basically saying they see further downside risk and wouldn't touch it. It perfectly summarizes the current mood, which looks like a classic hated rally setup.
And I hated rally.
Yeah, hated rally.
Yeah.
It's a scenario in the market where the backward-looking fundamentals, the
Mm-hmm.
massive cash burn, the negative margins, the missed deliveries, they're undeniably poor.
Right.
That data totally justifies the bears. But the forward-looking strategic catalysts, the Uber partnership, the new CEO, the Saudi backing,
Yeah.
they're so strong that they force a sentiment shift anyway.
Okay.
The stock starts going up, and everyone who is shorting it or sitting on the sidelines holding cash just hates it because their spreadsheets are screaming that it shouldn't be going up yet.
Right.
The price action totally defies the historical data.
Now let's talk about the risks, because to be fair to the bears, we do need to address the very real dangers involved here. This isn't some guaranteed home run.
Definitely not. We have to zero in on execution risk and dilution. Those are the twin destroyers of wealth in any speculative growth company.
Let's start with execution risk. The Q1 delivery miss, regardless of whether it was a third-party supplier's fault or not, it highlights severe supply chain fragility.
It really does. Manufacturing cars at scale is famously one of the most difficult logistical challenges in modern business.
Absolutely. If one single delayed component can bottleneck your entire revenue stream for a whole quarter, your operational foundation is brittle. It leaves absolutely zero margin for error.
And then there is the elephant in the room, which is dilution. When a company has an annual net loss of over $4 billion, the risk of continuous wealth-destroying equity dilution is just this massive dark cloud.
It's terrifying for shareholders.
Mechanically, if a company needs cash, they create and sell new shares of stock. But every time they do that, the total number of slices in the pie increases, which means the slice you own gets smaller and smaller. If they do it too often, your shares become practically worthless.
That is the standard fear, yeah. But this is where we have to look closely at how the recent $1.05 billion financing was actually structured.
Okay.
Because the mechanics of this specific deal significantly mitigate the threat of open market dilution.
How so? Like, what did they do differently?
Well, it wasn't done by just dumping newly printed shares onto the retail market. It was structured via convertible preferred stock and strategic private stakes from the Saudi PIF and Uber.
Right.
Convertible preferred stock acts a bit like a bond. It pays a dividend to the holder, and it can be converted into common stock later under specific conditions. It secures the cash today without immediately flooding the market with new shares and just crashing the price.
So it's a much more controlled injection of capital.
Exactly. And we also have to look at the macroeconomic incentive of the Saudi Public Investment Fund. The Saudis are highly motivated to backstop this company because they are protecting their massive investment in the AMP2 manufacturing facility.
Which is physically located in Saudi Arabia.
Exactly.
So this isn't just a stock trade for them. It is a sovereign infrastructure play.
It is a cornerstone of their national economic diversification strategy. They are trying to pivot their entire economy away from oil dependency.
That's a huge deal.
Right. They simply cannot afford to let this flagship manufacturing facility fail. That means they are highly incentivized to continually provide funding in a way that prevents uncontrolled equity issuance.
Because if they just dumped shares and triggered a death spiral in the stock price, it would jeopardize the entire project.
Yes. The PIF is effectively acting as a structural financial shield for the common equity holders.
So with everything on the table, what's the final verdict? We've got the brutal cash burn, the incredible underlying technology, the massive Saudi backstop, and the upcoming catalyst of the new CEO's strategic review.
Based on the synthesis of the research and the current price action, the official rating lands at a bullish score of 7 out of 10.
7 out of 10, okay.
The conclusion is that at these currently depressed levels, sitting right on that reinforced technical support at $5.50, the stock offers a highly asymmetric turnaround profile.
Meaning the potential mathematical upside vastly outweighs the remaining downside risk, assuming that floor holds.
Correct. The washout has essentially already happened. The weak hands have sold. Now, driven by clear smart money accumulation from Coatue and Uber and the impending strategic reset, the foundation for a turnaround is set.
But, and this is important,
Right, from a wealth-building perspective, the target horizon here must be a multi-year hold. This is not a quick day trade or a 2-week swing trade.
right?
You are strictly targeting the 2027 Saudi plant production ramp and the full commercialization of the robotaxi platform. You are buying the blueprint today for the autonomous city they're building tomorrow.
And if you want extra help reading trading charts and understanding technical levels like the ones we discussed today, you can check out VIP indicators through the link below. The campaign is grow $100 to $10 K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this deep dive helped you understand the mechanics behind the headlines, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Deep Dive.
Which leaves us with one final thought to mull over. Right. We talked extensively about the Saudis protecting their factory and Uber securing its future autonomous fleet. The big players are obviously building their moats. But if you are a retail investor buying a speculative plot of land based on someone else's extremely expensive fertilizer, well, what happens if those massive farmers decide they eventually just want to own the whole farm themselves? It's definitely something to think about as this turnaround unfolds.